Hey guys, Whitney here. Welcome to the Passive Investing Made Simple Masterclass. I'm your host, Whitney Elkins-Hutten, Director of Investor Education here at PassiveInvesting.com. And I am so excited today to talk about not only a really cool topic, preferred equity, but also to bring in my co-host and guest today. I'm not going to tell you who it is. If you're on video, you already know who it is, but I'm not going to tell you quite yet. Just a little bit of housekeeping. If you guys aren't already on our email list, go to passiveinvestingwithwhitney.com. There, I got some free goodies for you on that will give you better clarity and more confidence to go into your next passive deal. Also, you can hop on a phone call with me or a member of our investor relations team we can deep dive into your goals and what you're trying to do with passive investing as you scale your portfolio, and we can talk about our open deals. Make sure to join us at passiveinvestingwithwhitney.com. But as you guys know, we do this weekly masterclass live every Tuesday to help you learn the ins and outs of passive investing. And without further ado, I want to introduce our today's guest. If you guys aren't on video with us here today, Rob Gallo, our Director of Investor Relations. Rob, welcome to the show.
Oh my gosh, Whitney, thank you so much. Every time I think I see this intro, I just get so excited and thrilled about talking about the topic. So thank you, Whitney. A pleasure to be here.
Yes, yes. Well, and we were just talking briefly before we got on. We kind of almost broke the internet with like registrations for this show. And we
Yeah.
know a lot of people listen to the recording after the fact, so they register so they can get the link to the recording. But this is a sought after topic, and I really want to make sure that take investors through. We don't want to assume that everybody already knows what
Yeah.
preferred equity
Mhm.
is. But even before we go into that, Rob, just give us a little bit of quick bio, 60-second bio about who Rob is and what your role is here at passiveinvesting.com.
Absolutely. So again, my name's Rob Gallo. I'm the Director of Investor Relations at PassiveInvesting.com. I live outside of Chicago in the northern suburbs of Chicago. I have a family of two children, a wonderful wife, and a dog that seems to always get into whatever smells outside. But I've been at I've been at PassiveInvesting.com for just under a year now. Previously, I have been a healthcare strategy consultant for 18 years before that, and have been an LP with PassiveInvesting.com for about half that time. So very always had this bug for passive investments in real estate, and somehow still try to manage Airbnbs, but definitely passive investing is the way to go moving forward.
Yeah, you and I have talked briefly about unwinding our Airbnb portfolios, but
My gosh.
especially after the last 12 to 24 months, right?
Yeah.
Anyways, let's not dive down that rabbit hole. Let's stay focused for preferred equity, right? Because I want to kind of start off with defining it, because I know sometimes when I hop on the call with investors, they confuse the term between preferred return and preferred equity,
Yeah.
equity and common equity. Like there's a lot of confusion out there. So what exactly is a preferred equity deal?
Yeah, and I'm gonna use the sin of all sins. Preferred equity deal is a deal that has preferred equity in it. But uh,
You can't
let's
use the term. Just
I know you can't use it.
term, Rob.
So let's talk about the capital stack. So I think, as some of you know, that the capital stack is really the underlying financial structure that, when you get into a deal, of where basically the money is going to come in order to actually invest in that deal. So the capital stack in itself is usually made up of some percentage of debt, and usually that's coming from a bank, as well as, and this is just from a basics, as well as some stock or equity itself, and that's usually called common equity. Now, the common equity is usually broken out into the general partnership and the LP, and there's a few other nuances there. But really, what the capital stack allows you to understand is, okay, who gets actually paid first if there's cash flow in a deal. So first things first, debt is the first priority. So just in a normal operating month to month on an asset, that debt is getting paid. Then after that debt is paid, then it then breaks down into kind of that distributions that would go out to that next level, which would be the equity partners. Now, where preferred equity comes into place is that if a deal has a preferred equity position, it's going to sit right after that debt, but above that common stock. So in reality, in terms of the priority of payments, that preferred equity position is going to actually, from a priority standpoint, get paid before then the common stockholders. So it's really based off of actually how the capital structure and the capital stack is structured for a deal.
Awesome. Okay. Now I'm going to open Pandora's box a little bit
Okay.
here because so many people think, oh, okay, great. If I'm sitting right behind the senior debt, the preferred equity obviously is the best and safest equity position there is, right?
Yeah, sure.
Okay.
Sure.
Okay.
Yes, absolutely.
So, okay. Yeah. Anyways, guys, you have to know Rob. If you're on
Yeah,
video,
sorry. I'm
that's kind of
laughing.
tongue in cheek, tongue in cheek. But anyways, okay. So, from so help us understand the different, if we can compare it to ice cream flavors, the different flavors of preferred equity
Yep.
that are out there, and just how malleable that actual slice of the capital stack is.
Yeah, no, absolutely. So the interesting thing about preferred equity is that it can come in, as you said, multiple different flavors. I think the most traditional aspect of it is if you come in as a preferred equity position in a deal, it's kind of almost like a little mix of a little bit of a debt structure and a little bit of kind of how traditional equities stand up. And when I say that, I mean that usually as a preferred equity partner, you're going to get some type of like quote unquote guaranteed return. So just so we're clear, when I said it's definitely the best position to be in, is part of the capital stack on an equity side, absolutely. But nothing's guaranteed. Remember that. And I just want to make sure that's clear because we have a lot of people saying, well, wasn't that guaranteed? Well, in reality, it's not. But what that position allows you to do is a traditional piece. You are going to get some type of return. So let's say it's about 10% return on a monthly basis in a typical standpoint that you will receive basically right after that debt is paid. The other aspect of that preferred equity position is going to be more kind of almost like a general partnership where you get a specific percentage of usually what is the general partnership that is not necessarily paid out on that monthly basis, but at the time of a capital event like a sale, that's when that piece would actually come to fruition and the preferred equity partners would get a piece of actually that general partnership sale. So that's kind of the typical piece of how a preferred equity position is.
Mm-hmm.
The nuances, obviously, is that in some cases that initial part of that monthly return, maybe that's not actually paid out on a monthly piece and maybe it accrues so that it actually goes into kind of what would be considered almost like an accrual account, and then that gets paid off at the same time of that capital event. The same thing is that, maybe percentages of the GP could be different in terms of what that is. But in reality, there's always going to be a mix of kind of those two pieces that really make up that preferred equity position.
Mm-hmm. Well, and just having to dive into this for my own education and evaluation, and quite honestly, of preferred equity deals and funds, it's not always about the returns. What are some other cool things that come along with a preferred equity deal or a preferred equity fund?
Yeah, so I think the main piece is then the appreciation, because in reality, there's going to be that piece that comes out as part of that equity position. That in reality, if you're not going to get, let's say, that monthly or even that accrued piece, there's going to be a position in the fund that allows for, as the asset appreciates, that you can actually take advantage of that. At the end of that deal. And so I see a lot of folks that are coming in, and we have a specific fund kind of set up for this, but they want to take advantage of situations where, hey, there's great assets that are out in the market, and maybe they're struggling for various reasons, one or another, but it allows them to kind of get in and actually shore up that deal by basically being that next step in that capital stack, but also being able to take advantage of, the end equity position that then they will get back after a sale. And I know, Whitney, there's a lot of pieces too and nuances. So I'm going to ask you the question back. What are some other pieces that you often see in some of these deal structures?
Well, so I want to highlight some things that you said, right? It's not all about the front end return, right?
Mm-hmm.
There can be in a preferred equity deal, there can also be that back end return, the general partnership return. I think when I'm evaluating a preferred equity deal, like I'm looking to see if the return is cumulative,
Mm-hmm.
non-cumulative. I definitely want cumulative returns, especially if I'm not going to get that monthly cash flow, right? I want to know that my return is going to be cumulative until the deal liquidates or sells. I want to understand the general partnership, like how they're negotiating things,
Right.
like to get into a preferred equity deal, especially if you're going into a fund. I want to understand what kind of preference on liquidation,
Mm-hmm.
kind of like, because that's not always the given. The preferred
Yeah.
equity gets paid out right behind the senior debt,
Yep.
right? Maybe they've gotten cash flow the whole entire time and they're the last,
Yep.
right? There's so many different flavors. Obviously, guys, you have to read your PPM, right? It all boils down to the PPM.
Yep.
Um, Voting rights. Do you get voting rights? Control rights. What's the liquidation? What's the exit strategy, right? Those are all the different kind of things that can also um, play into here. But I don't want to steal your thunder,
Oh
Rob.
yeah, no.
Make sure to get into those top 10 questions that our investors are asking about preferred equity deals. What is one of the most common ones that you get?
Yeah, I think one piece that comes up quite a bit is that, all right, if I'm in a preferred equity position, do we have the right to actually force a sale? So again, coming from kind of some of those nuances that you really have to understand the preferred equity, it's really all about how it's negotiated, right? You could definitely go in and say, yep, this is what it's going to be typically, but it really depends on how someone coming in offering that, those dollars for a preferred equity positions, negotiating with the owner of that asset. So in a lot of cases, you can say that being in that preferred equity position, as long as it's right after the capital stack, is really good. But if the operator isn't necessarily going to operate it the way you want it to be, or even say, you know what, we've got a great offer on the table, and the operator says, you know what, it's good, but it's not what I think it could be. Well, if you're going to get your capital back and actually you're going to make not only, let's say, the preferred equity position, but a lot of the other investors in that deal whole, why not take it, as long as you understand kind of what's coming down the pipe in terms of the trade winds, or where, if it's a multifamily asset, kind of where things are headed. So that's a key question that people ask us, so that, when you're looking at deals like this, that you make sure to understand, okay, can you force a sale if you think, yep, this is the best offer on the table? Or is it more of a, what, you can't force a sale, but at least maybe you have some voting rights in determining, is this the right, if this is the right asset management company I want in place? Because in reality, we all know sometimes you could have the best asset in the best location, and some great tenants, but if the actual operator of that asset itself, the asset management company, is not doing its job, you're not going to see your returns, and you probably will never see your returns.
Mm-hmm. So that brings up a question that I have. It is, why would an operator, and I don't mean the fund operator, I mean, like, if you have a fund and you're looking to place deals, or preferred equity deals,
Mm-hmm.
so like 10, 12 preferred equity deals within your fund, right? You're looking to place that capital. Why would another operator even entertain that type of money?
Yeah, so I think two scenarios. Well, there's multiple scenarios, but let's start with two. So I think when you're initially doing a deal, so if you have, as an operator, you've identified, let's say, an asset, and you're like, great, this is the asset, and you go out and you get a loan from a bank, and okay, that's going to be my debt, and you go and you raise, let's say, almost 80% to 90% in equity on that deal, but you have a gap of about 10% that, no matter what you're doing to just, your typical investor base, you can't get there. Well, one thing an operator might say, well, in order to actually complete that gap, in order to get this deal done, I'm going to go to some folks that I know that have those dollars available, but really only want to get into a preferred equity position. So at the start of a deal, at the inception of a deal, that's where an operator might want to entertain that preferred equity, just to fill that gap. And I think it's something that we've seen kind of a lot, actually, in this past year and a half, with interest rates being, relatively high, and a lot of capital sitting on the sideline, that people have had to go and reach out to preferred equity partners in order to fill that gap. So that's kind of the first scenario, I would say. The second scenario that we're seeing, and specifically right now, is if you're in a deal, you're an operator, you've run the deal, let's say 2 to 3 years, and let's say all of a sudden you've got a floating rate interest loan, and your interest rate cap is expiring and coming up. Now, your reserves, let's say, are relatively healthy. You're able to hit your distributions. Maybe not. It's, you've got a lot of cash left over that's going in the reserves, but that you're still actually a healthy and good asset. But to buy that interest rate cap, it could be $1 million to $2 million depending on the size of that deal. And if you've been actually running, let's say, a pretty tight and making pretty tight operations and providing those distributions back to the actual investors, you might not have enough cash in order to actually purchase that interest rate cap. So what we see is a lot of organizations or operators have reached out to other preferred equity partners to see, hey, what kind of rates would you give me? What would a preferred equity position be? What would be the terms that we would negotiate? And it's really to allow them to make sure, yeah, we're going to get over this hump, make sure that, and in some cases, like the stuff that we look at, we always want to make sure that if there's a debt service that's out there, that the NOI is actually covering that debt service. If it's not, then if we are talking with someone about being a preferred equity position, it's okay. Well, let's pay down some of that loan so that we can cover that debt service. Obviously, yeah, everyone projects rent growth to go up. But what if it's stable? What if it goes up and down a little bit? Let's make sure we can cover actually that debt service first. Then we can talk about the rate cap. Then we can make sure, all right, if there's an additional rate cap coming up, how much in reserves do we have to actually do that? So anytime you're asking questions about this or you're involved with this, make sure you understand how is the money being spent, where is it being spent, and how are you making it sustainable so that, yes, at the end, we want everyone to be happy. We want it to sell. We want it to refinance to make a lot of cash for everyone. But what's the plan to get there? And does that make sense? So those are kind of the two areas that I really see preferred equity. Obviously, like you said before, there's a multitude amount of areas, but that's kind of what we're seeing a lot in the market right now.
Mm. Now I have a ton of questions, but I want to, bring it back to you. Like, you talked to hundreds of investors over the past couple of months about preferred equity. What are, some of the other top questions that they have, burning questions that people listening might actually have the same question?
Yeah. So a big thing is the current equity partners on a deal. So the current LPs on a deal that say, you know what? In fact, I got off a phone call with an investor right before this call, not talking about our deals, but we just started, riffing on just multifamily in general. And she's like, well, wait a minute. What do you guys do for preferred equity? Because I might want to connect you with my operator. The big piece from an LP is how much of a hit is that going to make on me, right? Am I going to be diluted at all?
If their operator brings in a preferred
partner? Correct. Okay. If their operator is bringing in a preferred equity partner, number one, what's that going to do to my returns? What's that going to do to my equity position? And again, you like to say that, typically speaking, it might not hit that LP, at least from an actual ownership perspective, because in reality, they're not doing a capital call. They're not actually bringing on more of that piece. However, depending on the deal structure, it could eat into, let's say, some of that small equity amount, as well as a lot of that kind of monthly, quarterly, or whatever those distributions are. Because what has to happen is that those distributions that are coming to you as an LP, let's say it's $1,000 a month. Well, a little bit of that is going to have to go to that preferred equity position. And even if it's being accrued, a little bit is going to have to go to that so that the operator can take advantage or basically take care of that preferred position first. So there's a lot of questions that come in about that, and very important to ask, what specifically can you project is going to happen to my returns, to my equity percentage, or really what's going to happen when we sell a deal.
Does that, and a follow-up question I had to that, like if you're an LP in a deal and the operator now has to, for whatever reason, bring on a preferred equity position or chooses to do that over doing a capital call, or maybe that's just the wise move to do. Like, does the limited partner, like in that deal, actually, have power to say no to that?
It's so great question. It's stipulated what's listed in the membership agreement that you sign. So if you, again, going back, read your PPM, always a critical piece. So outlined in the PPM should be information that basically says, okay, what stipulations does the general partner need to bring back to the limited partner in order to force a vote? So that vote being, yes, we agree to go this way, or no, we don't agree to go this way. So that's going to vary, honestly, on the PPM itself of, if the general partner does have to come back to those LPs. In some cases, general partnership does put in that 100% of management decisions, and this kind of being part of that, including the capital stack, they own the decisions to do that. Now, if it's where I see that kind of mixing is that if they're bringing on new equity, or if they're bringing on another, let's say a promissory note to actually bring into the deal, that's where we do see, at least in some of our cases, where yes, we have to go to a vote to the LPs to get 50% plus of their vote to actually move forward with some of these basically activities.
I would think as a limited partner, and I'm just thinking through this like out loud live, you guys, like if I'm in a deal and I know the deal is solid in a solid market and everything's, going well, and there just needs to be a little bit of infusion of capital, that the offering of a preferred equity position isn't actually that bad. Because one, I could potentially participate
Yeah. Yeah,
in my own
absolutely.
preferred equity, right? Like
Yeah.
ensure my own capital investment, or I wouldn't necessarily be diluted by the process of a capital call, you know. So okay, I'm just thinking through that out loud, guys.
Yeah, no, that was great.
Because I have been in that position as a limited partner, with another operator where there was a capital call, and just the reason why I didn't, it's amazing an asset. The asset is performing. By the time I couldn't participate in the capital call, for various reasons, but I was bummed because I got significantly diluted because I couldn't participate.
Yeah.
But this seems like a good solution, especially if you're a limited partner and you have a deal struggling with another operator and you're like, hey, let's play some connection here, networking.
Yeah. And it's so interesting because I think you hear, again, we've heard so much in the news about, fund or assets that are going underwater or defaulting, or there's just something going on. And a lot of people are talking about, well, why don't you get into distressed assets? Why are you doing that? Well, in reality, getting into distressed assets with that, and unfortunately, I know probably some of you have been in some of those situations, and I feel for you, but you understand that asset is probably not doing well. And some of the projections, hey, we're going to do a value add and take a C to a B, and this is our capital budget and it looks really small. That's probably not necessarily a situation you want to get yourself into, or even as a person that's looking to invest as a preferred equity position that you want to get into, right? Mm-hmm. You want to make sure that you're going with an operator or preferred equity position that, yes, you do actually, the asset's good, right? It's got to be a good underlying asset that has good occupancy, that, hey, if they're still trying to do a value add, have they proved that value add so that they're doing certain things to some units, and yep, they're seeing the rent premium, but in order to get to the returns that they want to, maybe they need some extra cash infusion in order to finish that renovation. So there's a lot of these other nuances to be considering on both sides of the ball.
So that brings me to, if somebody were going to invest in a preferred equity fund, what would they look for from the general operator of the fund as far as due diligence, strategy, negotiation? Like, what would they look for there?
So I think a clear strategy in terms of the investments that they're looking to invest in. I think there's a lot of funds out there that do this, right? And I've seen some that say like, yeah, we're going to get into any possibility, and that's great. But where I see some of those struggle a little bit is that if they're not clear, right? If they're not clear on how they vet all of those opportunities, and if it's not aligned with their core competency as an operator, how can you truly trust that they're actually going to make the right call and decision on an asset that might be having a little bit of trouble, right? So what I always like to see is, all right, so the acquisition strategy and the acquisition process that you go through to actually buy your own deals, are you utilizing that in the same way, as well as are you actually vetting the operators to make sure that they're doing a good job? So one of the things that we make sure to do before we get into this with our Pick Alliance fund is we look at all the other deals that operator is in. are these other deals having similar struggles, or are their occupancies good, or maybe have they defaulted on this? Do they have the capacity to actually turn this around and do what they say they want to do? And they've done it before, right? So it's that proven track record that we're looking at, because it's not just that single asset, right? You still want to have that operator making the appropriate decisions, even if you have that that opportunity to actually force a sale. You don't want to necessarily get in there and have to operate that additional business. You still want them to do it.
Mm-hmm. And do you see often in these type of funds where the operator that is receiving the preferred equity and the infusion into their capital stack, if you're looking at the rest of their portfolio, are they securing any part of those assets with the rest of the portfolio, or no?
And that's another piece, right? Because we want to understand how leveraged they might be and how much intertwined all of their assets are. Um, preferred equity can be a sticky piece because of the way that it's structured. If I think from an actual person that's investing in it, if you don't understand it, and if it just seems too overly complicated, probably not the best decision, unless you really understand that stuff. Because in reality, it feels like you have to have a master's in finance to understand how are we actually going to be funding this deal as we move forward. If it gets into a situation like that, where let's say they're using other assets to securitize things and everything's kind of wrapped up, and oh yeah, we're just going to do a wash of money from this asset to this asset, and that's how we'll pay the preferred equity. Not that people are going to be very front about that, but doing your due diligence, understanding how they operate as an operator in the first place, and making sure that there's not anything funny going on, that's going to go a long way in terms of saying, yep, this seems appropriate in terms of who and how we should invest.
Mm-hmm. I have other questions, but we've only gotten through like the top three questions that operators that, or excuse me, investors have asked you. I have some other questions that I know I've been asked on calls, but Rob, is anything else like popping top of mind, like another couple questions that investors are asking?
Um, I think that's kind of the majority of the ones that we hit on. I think the other piece is just understanding, again, what is the deal structure going to look like? Um, is this something that's actually going to be accruing? That's another typical piece, because I know in our structure, we accrue. So anytime we go and we do a preferred equity position, we accrue that percentage that is going to be paid out, kind of that initial fund. And I think really truly understanding that, and you as an investor to understand what does that mean for actually how I'm investing. Do I really need monthly, or is this more of a, yep, I can actually, take the appreciation on this and wait the 3 to 5 years that maybe this business plan works out. And I think that's another critical piece too, to ask. You are now kind of, I don't want to say at the mercy, but you are now invested into that operator's strategy, how they run their deals, and understanding their timeline is important. So you can say, all right, I'm going to take this, $50 or $100,000, whatever it is, and it's going to sit out there for, either 3 to 5 years until that deal's fulfilled. That's also an important piece. The last piece I'll say, Whitney, and I know you've got a lot of questions, depreciation. So this is where it's a little bit more difficult to give a straight answer on, because typically what we're seeing in some of the, say, just take a multifamily assets right now that we're seeing in the market. A lot of these assets that are seeking preferred equity are in kind of this position of trouble. They're about 2 to 3 years through their business plan. You can take advantage of depreciation that those assets offer in most cases, depending on who you're funding with as a preferred equity partner. But you can take advantage of the depreciation. But the key is because those assets are probably in year 2 or year 3 of that hold schedule, they've probably already taken the majority of their depreciation in year 1 and in year 2. So you're not going to see those huge depreciation losses hit your K1 or at the end of the year of your financials, but you will see a little bit. So that's another piece to consider as you're looking to either possibly invest or just be aware of the situation.
Yeah. So, for me, I'm constantly talking about the 7 pillars of wealth building, right? You're locking in capital preservation. If you do this correctly, okay, guys, if you underwrite and you do this appropriately, you can lock in good quality capital preservation, right? maybe not monthly cash flow, but you get that you're sitting behind the debt service, and so you're the next to get paid the cash flow at like liquidation, or possibly even get a little bit of cash flow from the asset. But it sounds like most deals right now that's not exactly happening. And then that equity piece, that's another wealth pillar you can protect, and then you do get a little bit of the tax benefits, but maybe that's not the priority decision for a lot of investors, right?
Yeah, absolutely. But those are always really good to count on.
Yeah. Well, Rob, thank you so much for, walking us through what preferred equity is, why investors should care, just some of the top questions investors have regarding preferred equity. Um, two things I would love for you to just to kind of, depending on when people are listening to this, like, maybe touch on, opportunity that, any opportunities that you have available, and how can investors reach out to you and learn more?
Yeah, absolutely. So first, if anyone has any questions about passiveinvesting.com or any of the opportunities that we have, you can reach me at rob@passiveinvesting.com. It's very simple. It's just rob@passiveinvesting.com. In terms of kind of just things that we have a preferred equity fund. It's called the PIC Alliance Fund that's set up specifically to actually invest in assets that, again, are good quality assets. They've got good occupancy, good collections, they're operating. But in reality, maybe they need a little bit more cash to actually buy that next interest rate cap, or that they need a little bit more cash in order to finish off those renovations so that they can actually realize either the premium rents or at the end of the sale. So we have a $20 million fund that is a greenfield. It is open until we hit that 20 million mark. We've invested in one asset so far, and it's doing well. Really, we took a $3 million position in that asset. 1 million was used to actually pay down the debt. I think we talked about that a little bit, so that the actual NOI could cover the debt service. The other was to make sure that we could secure the interest rate cap extension. And then the third piece of that was used to really bolster the reserves to make sure that, hey, if interest rates don't fall like some people are really suggesting they do, and hopefully they do towards the end of the year, but in case they don't, having enough cash to make sure that we can buy the next interest rate cap, in place, so we don't have to run into this situation again. So if you have any questions about the PIC Alliance Fund, some of the deals that we look at, or even if you're a person that says, hey, I'm with an operator that might need a little bit of help, please reach out, let us know, and we can connect the appropriate people to have those conversations.
Rom, as always, such a pleasure to have you on the show.